Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Now, when it comes to your portfolios over the past couple of years, let's face it, it's been a tough period. But you need to look at your portfolio and still judge whether the schemes that you've invested in have underperformed or not. Let me give you an example. For small cap mutual funds, if you look at the last 1.5 years, there's a quite high possibility that there are negative returns that have been experienced, especially on a point-to-point basis. But it's also possible that your scheme has underperformed everybody else's. Does that mean that you should exit? Or does that mean that you should give it a little more time? Let's talk about this instance of underperformance, how to judge it, and when to make a switch. I'm joined today by Prableen Bajpai, the founder of FinFix Research and Analytics. Prableen, thanks so much for taking the time. I think that this gets ignored to a large extent because people go on autopilot. Either people ignore it completely or people fiddle too much. Both are not feasible. So first, let's talk about how you would judge underperformance.
Hi, Alex. Great to be on your show. Yes, I think returns are something that we look at them. They can make us happy and satisfied at times. And periods like the current times definitely can bring about a lot of frustration amongst investors because it has been testing their patience. They can be worried and fuming at times as well. But do you need to react? Looking at that is the question, Alex, and that's really important because equity investing is a non-linear journey. It doesn't move up in a linear way, and when we are in periods when there is a correction in the markets, there has been a sideways market movement. I think these are times when investors definitely must be reviewing portfolios and judging in the right manner. So the first thing that they need to do, point number one, Alex, is that they need to understand and look at how the markets overall have performed. So for us, the last 1.5 years, starting from September 2024, has been a period where there has been a lot of turbulence. It initially started when we saw that the GDP numbers came in a little weak. We saw a dip in consumption. There were concerns over valuation. It got stretched with all the concerns regarding the tariffs, and almost a year was spent with those tariffs. And now the US-Israel war over Iran. So definitely, Alex, understanding the overall markets are not doing well can give some comfort to investors because you probably cannot expect to just judge your portfolio in isolation without knowing how the market movement has been.
So tell me about that, right? Prableen, how do you identify that your scheme is underperforming?
Right. So once we've established that markets have been underperforming, Alex, now we see that how my particular scheme has performed against the benchmark and the category average returns. And let's pick the FlexiCap space. The category average returns for the last 1 year are 9.8. Nifty 500 has given us 10.16% returns. And I'm taking three schemes here, Direct, Axis Flexi, PGIM Flexi, and Parag Parikh. Axis and PGIM has given us about 12.25 and 11.69% returns. And Parag Parikh has underperformed at 8.5% returns. So now, Alex, should I take a decision that, okay, my Parag Parikh has underperformed the benchmark and the category, and in fact, two of the other schemes? Perhaps no. Because if we look at returns and we compare against the category average and the benchmark and other peers, rolling return 3 year period over a 7 year, 3 year rolling returns over a 7 year period shows that Parag Parikh has outperformed all of these names which we've just mentioned, and that too with a decent margin. Likewise, its performance since September 2024 till March of 26 has been the best. So while the benchmark has fallen by 13 average return, 13% on an average, the other two schemes falling by 7 and 6%, Parag Parikh has managed to stay in positive with 0.9% returns, almost close to 1% returns. So if you're looking at just a very short-term performance, then don't judge the scheme just by that. Look at long-term returns, look at SIP returns, look at rolling returns. That's very important. Next, Alex, so you're judging it against the benchmark and the category, and you're looking at different returns. Then what comes next is the risk-adjusted returns. So let's say if my scheme has given me negative 10%, or the other scheme has also given negative 10% or positive 10% returns, whatever the returns may be. Now we need to look that these returns came at what level of risk. So risk adjusted returns, and risk adjusted returns can be measured by different matrices, like you have the Sortino, you have the Sharpe ratio, you have the information ratio. And all of these can help us decide on a scheme where the risk wasn't too high, but the returns were decent. So that's the point four. And then other measures, Alex. For example, how has the fund manager been doing? Has there been a change in the scheme, a fundamental change in the scheme, or the top management of the AMC? And what is the investment style of the scheme? So I think all of these factors cumulatively can help investors judge whether the scheme is actually underperforming, and if it's really a reason to worry, or it's just that they need to stick around with the scheme for a little longer.
Now, I mentioned at the start that there are broadly two things that I've seen happen, Prableen, with investors. There is a tendency to fill it, shut it, and forget it, in which case certain problems can compound, or there is a situation where people fiddle too much and they see, oh, there is an underperformance, let me move this. Changing of lanes very often. So can you give us a few examples of mistakes that can compound, or situations where mistakes can compound over a period of time and create a problem?
Absolutely, Alex. And you've just said it, that those switching lanes, I think we've all tried that and failed miserably during the peak traffic hours. It doesn't really help.
No, I must tell you, I have the worst luck, Prableen, when I'm taking in the expressway.
Likewise.
When I'm going to when I'm going to get through the toll, always the toll that I've selected has the slowest line. It doesn't matter what I do.
So I think that it's the same thing for investing also, Alex. It doesn't really help. And I'll give you an example. We tend to chase, or we tend to look at areas which are comforting. I will not even call it chasing. What investors, I think, really are looking for is some comfort that, okay, this scheme is in positive. Probably I should shift to that scheme, without realizing that what they're seeing is already the past. It's not the future. So if investors are able to realize that when they're looking at alternatives, they're also looking at the past and not the future, it can really help and, probably calm them down. So definitely the mistakes are that you're looking at better alternatives in terms of, some element of chasing and the changing lanes involved. Second, Alex, is that, looking at the hot categories, a very small segment, for example, Silo has done so well that it has attracted so much of inflow. But will we continue to see those returns? And, these are times when you see all sort of biases come into play. For example, confirmation bias, this framing bias, all of these come into play because there'll be stories that now silver will reach these levels. And, likewise in equity markets, when they're doing well, we have all these levels for Sensex and Nifty as well. Their third mistake is over allocation, I think, within a certain category. So when, we do all these question answers, we see portfolios for investors, Alex, we sometimes see when markets are doing well, there's over allocation to small caps. And then, a large part of your portfolio starts to get hit. And finally is, the changing lane system that we have. Within that, if you're trying to move, the compounding process gets disturbed. And I'll give you a classic example here. 2017 March to 26 March, if we see, the mid-cap index has given us 17%, almost close to 18%, and Nifty 50 was at 11.2%. But Alex, from 2017 March to 2019 March, mid-cap index was negative 2% and Nifty 50 was positive 7%. If you tried and changed that, okay, I have to stop my mid-cap now and I have to, sorry, that was the mid-cap index and the Nifty 50. So if I have to stop my mid-cap index now and only invest in the large cap, 9 years later, probably you won't have been that happy. Yeah. So sometimes you also have to go through periods of downturn, and that is, I think, a given in equity. So unless and until, there is a specific problem with the scheme, I think don't keep switching lanes.
Particularly when you're, and while we're talking about the switching of lane problem, Prableen, is that the tendency is to move into something when it is at its peak. And
yes,
actually you're supposed to do it on the opposite end. It's easy to say that you should buy when there is fear and you should sell when there is greed. But it's harder to put into practice because this is just human psychology. But can you give us examples of when these switches happen? Because ultimately you're talking about tendencies towards certain styles, right? A quality style might work in some years, a value style might work in some others, a momentum style might work in a few years. So can you give us examples of this?
Yeah, it's interesting, Alex. So if we are looking at the previous, 1.5 years, Nifty 50, which we can call as a standard growth style of investing, has given us negative 7.46% returns. The Nifty 50 value index has given us negative 14.74% returns. And the momentum index, the Nifty 200 momentum 30, has given us negative 20% returns. And these are the times you're not wanting to touch momentum, because momentum is something which has not worked in the past 1.5 years. It just doesn't work in sideways markets. Likewise, we saw post COVID, Alex, that initially growth stocks performed and then value took over. So understanding that there will be changes in styles as well, when they work, when they don't work. So it is across styles. Your portfolio has to be diversified in terms of having some value in some growth as well as quality and momentum. Likewise, Alex, it also applies on the market caps. So there are times in high volatility, mid caps and small caps will get beaten down much more than large caps. But you don't switch out of everything which is there in the mid and small if you have a long term horizon. So, very, very important thing, Alex, for investors who are listening, that if your horizon is long term, then only all of this applies. If your goals are very near, let's say 2 or 3 years away, then of course you have to move towards something which is safer. But if you have a long term horizon, then you stick to the plan, and that is what is required. Because over a 10-year period, when we see these different styles, the value index, the momentum, and the growth style, the Nifty 50, what I spoke about, over a 10-year period, Nifty 50 gave us 11.3% returns, value gave us 12.68%, and momentum gave us 15.24%. And this is despite the falls in the last 1.5 years, Alex, I have mentioned. So despite that 14 and 20% fall and 7% for Nifty, these are the returns. So it's not an easy journey. It's not, if it was that simple that you keep looking at the better performer and buying it, you're continuously buying the past performance, and that will not work. What we need to look at is buy low, sell high. And if you can overcome that fear, I think, and not be greedy about it, of course, and, expect moderate returns, that is what works in the markets.
Okay, now coming to the crux of it, which is how do you correct underperformance? Probably, do you do it by holding on to what you've invested in? Because ultimately, there's a possibility that you're still making capital gains. And if you book out, then there's going to be a tax that you pay on capital gains as well, right? So there is a cost involved in switching. So do you switch incrementally into something else?
So if you have, let's say, identified underperformance, Alex. So first you identify the underperformance, that, okay, these are the schemes which are not performing, and you place them under checklist. So give them 6 months, 8 months, let the market stabilize, but you can definitely mark them in your portfolio. Once you've done that, that means that you've given adequate time to it to perhaps recover, but also see, in the backdrop, how have the markets performed. But let's say if you've identified something which has actually outperformed, and there is a definite reason why the underperformance has happened, then definitely you can switch out and look at a better performer within the category. There is no harm, and then you shouldn't be looking too much at the tax angle, Alex, because then let's say if you're eventually able to make a 4 or 5% alpha because of this underperformance which was getting hampered, ultimately it would nullify. But I feel the reason and that clarity must be there why you're out moving out of something. It shouldn't be because of any temporary short-term underperformance. And as an advisor, that is what we see. That is that underperformance coming due to something which is, specific to the scheme, or is it specific to a style of investing or the overall trend which is happening in the market? So definitely moving out of a scheme is important. So what you can do is you can stop your incremental flows, give it time, and allocate to something which you feel is doing better, if that gives you comfort. But don't do a knee-jerk reaction. I think stopping additional inflows is the first step, and then gradually taking a full exit, probably over 2 financial years, can also help you with a bit of taxation, like you mentioned.
Yeah, well put, well put. And the example that you've given of the Parag Parikh Flexi Cap Fund is an ideal one, because when markets were doing relatively better and the cash position was high, there was a lot of criticism about why things were not looking good. But I think now would be a good opportunity, and perhaps we should see the performance in 3 or 4 months from now if the markets do stabilize and go up, because they might be utilizing this time to deploy. Thanks so much for taking the time,
Absolutely.
Praveen. Pleasure speaking with you as always.
Likewise. Thank you.